Did you know that at least 80% of your portfolio returns comes down to asset allocation? But what exactly is asset allocation and how do you determine the right mix? Today we explain these questions in 4 basic steps. Asset allocation is the distribution of wealth in various asset classes. Common examples are bonds, equities, or alternative investments. When you invest in different asset classes, you reduce your risk and potentially increase your returns. And if another asset class does well, you're less likely to miss out on market opportunities. One of the main aspects of asset allocation is diversification. Think about diversification this way. Let's say you're passing through a city where there are kiosks. It's January and you walk past a street vendor who is selling ice cream and sunblock, as well as cups of hot chocolate and umbrellas. At first glance, it looks like these are all unrelated items. But let's say there's some sun that's shining through, and then it's easier to sell sunscreen and maybe even ice cream. And when the weather is cold, suddenly a nice cup of hot chocolate or even an umbrella when it's raining doesn't seem like such a bad idea. The magic word here is diversification. Don't put all your eggs in the same basket. This is true for the individual asset classes. Take equities. It would just be really risky to invest in just one company or in just one sector or one country. The overall objective is to protect yourself against unnecessary losses and achieve long-term financial goals. But how do you determine which percentage of the different asset classes is right for you? There are 4 steps to consider. Step 1, determine your goals. As you progress through different stages in your life, your needs change. Perhaps you've just gotten married, you're thinking about starting a family, and maybe even buying some real estate. Or you're at a later stage in your life and you'd like to maybe retire early. These are all important financial considerations for you. Get a clear picture of what your long-term financial commitments and goals are before you make any investment decisions. Step 2, identify what type of investor you are. Depending on your overall objective, investment advisors typically define an investment strategy. The 2 most important aspects you should consider in this regard are 1, your risk tolerance, and 2, your knowledge and experience. Aspect 1 is all about determining your risk tolerance. Ask yourself 2 questions. How much financial risk can I bear? And how much risk do I want to bear? Are you considering aspects such as your age, your certainty of income, how far you are away from retirement provisions, and your planned living expenses? What's on your horizon? The second question, how much risk do I want to bear, is equally important. Imagine you invested $20,000 and you lose $7,000 due to market volatility. How do you react? Will you stay the course or will you want to sell immediately? Let's take an everyday scenario. You're in a hurry, you're waiting in line for your morning tea or coffee. You see that one line seems to be moving faster than the other, so you hop on over. But then it turns out everybody's doing the same thing, and before you know it, your original line moves past you. If you get stuck with your original decision, you'd be fine. When things are in an upheaval and the markets are going crazy, are you confident in your investment capabilities and will you stick to your investment strategy? Or will you follow what everyone else is doing? You have to be very real with yourself and get clear about your personal attitude towards losses. Banks typically distinguish between a low, moderate, considerable, or high risk tolerance. Let's now have a look at your knowledge and experience. Maybe you're an avid reader or even study finance as a subject at university. Are you familiar with asset classes, financial indexes, and the dynamics of financial markets? And more importantly, do these topics interest you? The combination of your overall investment objective, your risk tolerance, and your financial knowledge influences which investment strategy and asset allocation suits you best. Step 3, select an investment strategy. There are a million ways in which you can build your portfolio. If you have a very low risk tolerance, the percentage of bonds in your portfolio should be higher compared to equities. Or if you're seeking higher returns and you're willing to take more risk, the percentage of equities and alternative investments will be higher. There are countless other possibilities, but it really depends on what works for you. Your asset allocation should always be in line with your overall objective, your risk tolerance, and your financial knowledge. Step 4, decide how you want to make investment decisions. The international financial markets are volatile by nature. One day you might wake up and find that positions have increased or decreased in value tremendously. So the last question you might want to ask yourself is whether you enjoy following financial news, discussing them with investment professionals, and making decisions with them, or whether you prefer to delegate the decision-making to experts. Some investors prefer a combination of both. They delegate 80% of the portfolio and keep 20% where they play a more active role. If you want to discover more useful resources around investing, wealth planning, and megatrends, please visit the Julius Baer website.